You probably think the money in your wallet is just a tool for buying things, but what if that's only a tiny fraction of the real story? The truth is, we rarely stop to ask what money actually is. Let's strip away all the assumptions we have about dollars and cents. Look, money isn't a physical object you can truly own. It's more like a shared story, a belief system we've all silently agreed to. Honestly, when was the last time you held a dollar and wondered about its journey? That journey starts long before coins or paper in a world without banks. Picture a small, ancient community that needs to trade. How do you exchange a basket of grain for a new clay pot if the potter doesn't need grain? Barter sounds simple, but it's wildly inefficient and frustrating. You need something that acts as a middleman, a common language of value. But what makes a good candidate for this job? Early societies tried all sorts of things, from seashells to cattle to giant stones. Some of these choices seem utterly bizarre to us now. So why did a huge, immovable stone wheel become considered valuable? The answer lies not in the object itself, but in what it represented. It was durable, difficult to obtain, and everyone in that society acknowledged its worth. That last part is the real magic trick of any monetary system. Without that collective belief, money is just a useless rock or pretty shell. Think about the gold coins that later ruled the world. Was the gold inherently useful, or did we just decide it was special? Sure, gold is shiny and doesn't rust, but you can't eat it or build a shelter with it. Its primary value came from being rare and hard to counterfeit. Gold became a physical anchor for that shared story of value. But carrying heavy metal is risky and impractical for everyday life. So we invented paper notes, simple promises that represented the gold in a vault. That was a monumental leap of faith, don't you think? You traded solid metal for a piece of paper with ink on it, and for a long time that paper was just a convenient claim check for the real thing. Then, one day, the anchor was cut loose. Governments removed the promise to exchange your paper for gold. Suddenly, your money was backed by nothing more than a government's decree. This is the world we live in now, a world of pure faith-based currency. It's all trust, a global agreement that these numbers in a bank computer mean something. But what happens when that trust starts to fray? You know, our entire financial system relies on intermediaries to keep the story straight. We trust banks to hold our money and governments not to print too much of it. That's a lot of power to place in the hands of a few centralized entities. History shows that this power has been abused time and time again. Currencies have been inflated away, becoming worthless by the billions. So we arrive at a pivotal, modern question. Can a form of money exist without a central authority controlling it? Can the story of value be written and maintained by everyone, not just a powerful few? This isn't just a theoretical puzzle anymore. In 2008, a mysterious proposal for a new kind of money appeared online. It was called Bitcoin, and it claimed to solve this ancient problem. But to understand why it's so radical, you first have to see money for what it truly is. We've been using a fragile, human-controlled system for thousands of years. What if the next chapter wasn't controlled by humans at all? The birth of Bitcoin didn't happen in a bank or a government office, but in the shadow of a global financial crisis. Honestly, the timing was no coincidence, as trust in the entire system was at a breaking point. Its creator, known only as Satoshi Nakamoto, proposed something almost unthinkable. What if money could be governed by unbreakable mathematical rules instead of fallible people? The proposal was a peer-to-peer electronic cash system, a network with no central server. Look, this meant no company, no bank, and no government could control it or shut it down. But how do you create digital money that can't be copied and pasted infinitely? This is the double spend problem that had baffled computer scientists for decades. You can't just email a digital dollar because then you'd still have the original file. Satoshi's solution was a public ledger, but one that was distributed across the entire world. Imagine a shared accounting book, copied thousands of times and updated by a network of strangers. This ledger is called the blockchain, and it records every single transaction ever made. Now, here's the tricky part. Who gets to add a new page to this shared book? In a traditional system, a bank has that exclusive privilege. In Bitcoin's system, that privilege is earned through a process called mining. Miners use massive amounts of computing power to solve a complex cryptographic puzzle. The first miner to solve the puzzle gets to add the next block of transactions to the chain. They are then rewarded with newly created Bitcoins for their costly effort. This process is called proof of work, and it's the ingenious heart of the system. Proof of work makes altering past transactions astronomically expensive and practically impossible. You'd need more computing power than the rest of the entire network combined. So the security doesn't come from a vault or a law, but from raw, decentralized mathematics. But wait, why would anyone spend real electricity on this digital puzzle? The incentive is built right into the code, with those new Bitcoins as the reward. This turns the security of the network into a global competition with a real-world cost. You know, it's a bit like digital gold mining, but the pickaxe is a computer. And just like gold, there's a strictly limited supply programmed into the system. The code dictates that only 21 million bitcoins will ever be created. This hard cap is a direct rebellion against the history of inflationary currencies. Can you imagine a government money that could never ever be printed beyond a set limit? This scarcity is encoded, not promised, which is a fundamental shift. So what do you actually own when you own a Bitcoin? You don't own a digital file sitting on your computer. You own the right to transfer a specific entry on that global public ledger. It's a unique cryptographic key that proves you can authorize that transaction. Your wallet is really just a pair of these digital keys, one public and one fiercely private. Lose that private key and you lose access to that Bitcoin forever. There's no customer service. Forget your bank password, and they can usually help you recover your account. This personal absolute responsibility is a feature, not a bug, in this new system. It places the burden of security and ownership squarely on the individual. That's a level of financial self-reliance that's completely foreign to most of us. Now, let's think about what this means for the nature of money itself. We said money is a shared story, a belief system. Bitcoin's story is written in code, verified by math, and maintained by a decentralized network. Its value isn't declared by a state. It emerges from the collective belief in its rules. But can a system like this ever be more than a fascinating experiment? Can it become a new anchor for our global story of value? Let's press pause on the technology for a moment and look at the deeper philosophy at play. Bitcoin isn't just a new kind of money, it's a protest against the very idea of trusted third parties. It asks a profoundly simple question: why should we need permission to use our own value? For most of history, moving value required the approval of a king, a bank, or state. These gatekeepers could freeze accounts, reverse transactions, or devalue the currency itself. Bitcoin's network, by design, is permissionless and censorship resistant. No one can stop you from sending your Bitcoin to anyone else on the planet. That's a radical kind of freedom, but also a radical kind of responsibility. You know, it turns the concept of money from a social contract into a cryptographic fact. The trust is transferred from institutions and placed directly into verifiable code. But let's be honest, this creates some serious practical friction, doesn't it? The network can be slow, transaction fees can spike, and it uses a lot of electricity. These aren't just technical glitches, they're inherent trade-offs of its robust security. The proof-of-work mechanism is deliberately costly to make attacks prohibitively expensive. So is the environmental cost a fatal flaw or the necessary price of a new foundation? That's a heated debate, and it leads us to a crucial fork in the road. Other digital currencies have since emerged, trying to solve these perceived problems. Some abandoned proof-of-work for alternative systems like proof-of-stake. These systems can be faster and use far less energy, but they work differently. Instead of competing with computing power, validators are chosen based on how much currency they stake or lock up. This method re-centralizes influence somewhat, placing power back with the largest holders. So, you see, every design choice involves a trade-off between security, decentralization, and efficiency. Bitcoin chose an unforgiving path of maximum security and decentralization, even at the cost of speed. This makes it less like digital cash for a coffee and more like digital gold for a vault. Its primary role is shifting from a medium of exchange to a store of value. And that's a role with a very long and troubled history. Look at all the things humans have used to store value across centuries: land, art, precious metals. Why do we keep searching for an asset that can hold its worth over generations? It's because our government-issued currencies are designed to slowly lose value over time. A small, steady inflation encourages spending and borrowing, not long-term saving. Bitcoin's fixed supply directly challenges that entire economic model. What happens to an asset that cannot be inflated, no matter how much a government might want to? Its price becomes purely a function of demand against an utterly inelastic supply. That leads to incredible volatility, which seems to contradict the idea of a stable store of value. But volatility often decreases as an asset's adoption and liquidity increase over time. Think about it. Was gold's value stable in its first few decades of use? Of course not. Its monetary role emerged slowly through trial and error. We are arguably watching the same painful, volatile birth of a new monetary asset. This forces us to re-examine what money even means in its different forms. Money has three classic functions: a medium of exchange, a unit of account, and a store of value. Historically, a single thing like gold tried to perform all three roles. In our modern system, we split these roles between different instruments. We use dollars for daily exchange, but we might buy stocks or bonds to store value. So where does Bitcoin or any cryptocurrency fit into this fractured landscape? It might not need to be your everyday spending money to be profoundly important. It might simply be the hardest, most predictable form of savings the digital world has yet created. Let's dig into that idea of hard money, a concept that feels ancient but is suddenly cutting edge. A hard money is one that is difficult to produce, making its supply resistant to sudden increase. Gold is the classic historical example. because you can't just wish more of it into existence. Soft money, by contrast, is easy to produce or inflate, like paper currency from a printing press. Throughout history, rulers have always been tempted to debase their soft currencies, watering down the value. They'd mix base metals into coins or print endless paper to pay for wars and debts. The people holding that money would slowly, or sometimes quickly, see their wealth evaporate. Bitcoin's algorithmic hardness is its most revolutionary and misunderstood feature. No ruler, no committee, no matter how powerful, can change its 21 million supply limit. That immutability is written into software that thousands of independent computers enforce. But honestly, does a money need to be physically tangible to be considered real? We've already accepted that most of our money is just digital entries in bank databases. The physical cash in circulation is a tiny fraction of the digital numbers we treat as wealth. So our money is already digital. It's just centrally controlled and issued. Bitcoin proposes a digital money that is decentralized and algorithmically issued instead. The shift from central record keeping to a shared public ledger is a deeper change than it appears. It means transparency is forced upon the system. Every transaction is visible to anyone who looks. You can track the flow of bitcoins in a way you could never track the flow of dollars. Yet, the identities behind the transactions can remain pseudonymous, protected by cryptography. This creates a strange duality of total transparency and personal privacy. Now, this transparency leads to another big question. Is Bitcoin truly anonymous? The answer is no. It's more accurately described as pseudonymous. Every transaction is permanently tied to a public address, a long string of letters and numbers. If that address is ever linked to your real identity, your entire financial history becomes visible. So it offers privacy, but not the perfect secrecy that some early myths suggested. This has major implications for how we think about financial surveillance. Governments can track traditional money flows through the banking system with relative ease. A decentralized ledger actually makes certain types of forensic analysis incredibly powerful. Law enforcement can sometimes follow the crypto trails better than cash trails. This isn't the outlaw currency people once feared. It's a new kind of transparent financial infrastructure. But infrastructure for what exactly? Look at countries with hyperinflation or unstable governments and banking systems. For citizens there, Bitcoin isn't a speculative investment. It's a lifeline. It's a way to preserve savings when the local currency is melting by the hour. It's a way to send or receive remittances without crippling fees or bank approval. In these cases, it's directly fulfilling the oldest purpose of money, preserving value across time. This gets us closer to the core nature of the thing. Money, at its heart, is a tool for moving economic value across both space and time. You work today, get paid, and that money holds the value of your labor until you spend it next month. A good money loses as little value as possible during that waiting period. A bad money, like a rapidly inflating currency, fails at this fundamental task. So the real test for any new monetary asset is time, and a lot of it. We've had thousands of years to observe gold's properties as a store of value. We've only had about 15 years to watch Bitcoin. Its youth is its biggest vulnerability, but also the source of its explosive potential. Will its digital, intangible nature be its ultimate weakness in the long run? Or is that very intangibility the key to its survival in an increasingly digital world? The nature of value itself might be evolving, from something you hold in your hand to something you hold in a network. This isn't just a financial shift, it's a philosophical one. Think about the word currency for a second. It comes from the idea of a current, of flow. Money's true purpose is to flow, to facilitate the exchange of goods, services, and ideas. A money that gets hoarded and doesn't flow contradicts its own basic function. So, is Bitcoin's tendency to be held as a store of value a sign of failure or a phase of maturation? Honestly, early forms of gold were likely hoarded by kings long before they became common coins. Every new monetary good goes through a period of being accumulated before it circulates widely. The network needs to build enough value before people feel secure spending it casually. This creates a strange chicken and egg problem that every new money must solve. You need people to believe it has value before they'll accept it, but it gains value as more people believe. This is the bootstrapping of a consensus, and it's happening in real time with crypto. Look at how we assign value to something as ephemeral as a piece of art or a brand name. It's all collective belief, and that belief can be shockingly fragile or surprisingly resilient. Bitcoin's belief system is built on the unflinching reliability of its code and its decentralized network. But what happens when the code needs to change or upgrade? This is where the human element crashes back into the algorithmic paradise. Changes to Bitcoin's core rules require consensus among the diverse network of users, miners, and developers. No single entity can force a change. A majority must voluntarily adopt it. This has led to fierce public debates and even splits in the network called forks. These forks are like philosophical schisms, creating entirely new currencies from the old one. It's messy, public, and slow, the opposite of a central bank's closed-door decision-making. That slowness is a feature, making rash changes impossible and ensuring extreme stability in the rules. This governance model might be one of Bitcoin's most important innovations. It proves a decentralized system can maintain itself and evolve, however awkwardly, without a leader. Now let's step back and look at the broader landscape this has created. Bitcoin sparked a Cambrian explosion of thousands of other cryptocurrencies, each with different goals. Some aim to be global computing platforms, others to tokenize real-world assets like property. This entire ecosystem is often lumped together under the term crypto, but that's misleading. Bitcoin's primary narrative is monetary. It wants to be sound money. Many other projects are more like venture-backed tech startups, building new services and applications. The confusion between these two very different ideas causes a lot of market noise and misunderstanding. So when you hear about wild price swings or project collapsing, ask yourself, is this about money or an app? The two experiments are running in parallel, but they're not the same thing. This brings us back to the pure, stark simplicity of Bitcoin's original proposition. It doesn't try to do everything. It tries to do one thing well: be predictable, scarce, and neutral money. Its lack of features, compared to flashier competitors, might be its greatest strength. Complex systems break in complex ways, but simple, robust systems can endure. Think of it as a digital bedrock, a foundational layer upon which other innovations could potentially build. But will it remain the dominant pillar in this new architecture of value? That's the multi-trillion-dollar question without a clear answer. History shows that monetary standards can last for centuries before being displaced. We're in the earliest, most chaotic chapter of this possible transition. The only certainty is that our deeper study of money can't stop here. The true test for any form of money is how it weathers crises that shake the foundations of trust. Look at the global financial panic of 2008, the very catalyst for Bitcoin's creation. Now, look at more recent periods of high inflation and geopolitical instability. In these moments, people don't just reach for dollars or euros, some reach for digital assets. This isn't theoretical anymore. It's observable behavior in the market. But does that behavior signal a lasting change, or is it just speculative fear and greed? Honestly, it's probably a messy mix of both, which is how all monetary shifts begin. The path from a novel idea to a global reserve asset is unimaginably long and littered with failures. Remember, countless private currencies and alternative monies have risen and fallen throughout history. Many had compelling ideas, but they lacked the network effects or the security to survive. Bitcoin's first mover advantage and its relentless focus on security give it a unique fighting chance. You know, its value is now measured in trillions, a fact that would have seemed absurd 15 years ago. That market capitalization represents a staggering amount of collective faith in a piece of code. Yet this faith is constantly tested by volatility, regulatory pressure, and technological challenges. Governments are now grappling with how to treat this stateless, decentralized phenomenon. Some want to ban it, others want to regulate it, and a few are starting to adopt it. This tension is inevitable when a new form of money challenges the state's oldest privilege, the mint. So, will nations eventually co-opt this technology, or will they try to dismantle it? The answer will vary wildly from one country to the next, creating a fragmented global landscape. This could lead to a future where your choice of money is also a choice of governance and values. That idea is both empowering and deeply unsettling, depending on your point of view. Let's return to our original question. What is the nature of money? We've seen it as shells, metal, paper, digits in a bank, and now entries on a blockchain. The physical vessel changes, but the core function, a ledger of who owes what to whom, remains constant. Bitcoin simply proposes a new, decentralized way of maintaining that eternal ledger. Its innovation isn't creating value from nothing, but in securing the record of ownership without a central authority. This shifts the fundamental power dynamics of the financial world. The story of money is, ultimately, a story about power and who gets to control it. For millennia, that power was centralized in temples, palaces, and later, skyscrapers. What happens when that control is diffused across a network of anonymous computers? We don't fully know yet, because we're still writing that chapter. The experiment is open source, playing out in real time for anyone to watch and participate in. This brings our deeper study to a close, not with a definitive answer, but with a clearer set of questions. Money isn't a static object. It's a living technology that evolves with human society. We move from weighing metal to trusting paper and now to verifying cryptographic proofs. Each step required a leap of faith into a new system of trust. Bitcoin is the latest and perhaps most audacious leap we've attempted. Whether it succeeds or fails on its own terms, it has already succeeded in one crucial way. It has forced us to look at the money in our pockets and the numbers on our screens with entirely new eyes. It has made us question the invisible architecture of our entire economic world. And that, perhaps, is the most valuable currency of all, a deeper understanding